Welcome back. Let me invite Sunil Subramaniam from Sundaram Mutual Fund on the show now. Sunil, the stock of the week has been HDFC Bank. It's a hot favorite in every mutual fund portfolio. And this stock has seen a fall of about 20%. What have you made of the market reaction to the numbers? Because we already had the provisional numbers. We knew the deposit mobilization was weak. So thoughts on HDFC Bank, what it tells you about the rest of the private sector banks and the kind of performance or the outlook for these banks?
I can't talk stock specific on HDFC Bank, as you're aware, right? So I can't comment on what's specifically happening there. But overall on the private sector banks, I think it's just a process of realignment of the banking space essentially happening because one, of course, the merger has caused an excess allocation to them. And wherever regulators, whether it's foreign or Indian, have a specific limit on a particular stock, they allow grandfathering for a period of time, right? So that you can gradually get your portfolio right? So people don't rush to do it then, but they wait for a moment in time when they can do that. So I think it's just a confluence of that happening. Otherwise, I see no cause to worry about the private banks. Yes, from a business model perspective, 3 or 4 things have affected their model. Number one is that the shrinking of the NIMs, because the low-cost monies that all of these private sector banks raised during COVID and the soft interest rates and ample liquidity then have probably run out in terms of their whatever they agreed then, and then they have lent it out. So that's number one. So there's a low-cost base has gone up, and newer deposits are obviously coming at much higher cost. That's the NIM part. Second is on the private sector banks, they are largely retail lenders. So to that extent, the excess growth in that has come to the notice of RBI. RBI has flagged concerns and also talked and introduced capital adequacy norms and lending to them and to NBFCs, because NBFCs in turn also majorly participate in the retail lending. So clearly RBI has highlighted and flagged off a concern. So the incremental capital adequacy will mean that to that extent their profit margins on retail lending will be impacted. Plus, there will be increased competition, which could lead to a further erosion of margins. This is the second concern. But the third is probably also something is that the way forward for these banks is that in terms of the growth, and you can clearly see that while the capex cycle has currently got delayed because private sector capacity utilization hasn't really taken off after shooting up post the second wave, it's flattened out. But sooner or later, maybe 6 months, 9 months later, when the capacity utilization picks up, you will see the private sector capex, which today is in a talking stage. All the private sector companies are talking about capex, but not implementing on the ground with action. So that I would say is something like an end of the year phenomenon. But that growth, which will largely mean lending to large capacity expanders, as well as the capital goods suppliers to the execution of that capacity expansion, right? So there'll be a small and medium scale lending and a large corporate lending. In these, most of the large private sector banks are not so strong as the public sector banks because the big ticket lending, right? The model of private sector banks has been to spread your risk over as many customers as possible so that you run it like a program and you can use algorithms and everything to control the risk there. And that's a very different ball game. Whereas corporate lending is very different. It's about talking about project, cash flows of the project, structuring your loan to that, and then bidding that. And there, I think that there is a sense that the large public sector banks would probably take the lead. And to some extent, I think the new loan growth, you would probably see it tilted in favor of a larger public sector bank as opposed to a larger private sector bank. So there is some realignment of valuations to that extent. That being said, I don't see any risks or any concerns with any of the large private sector banks. I think their NPAs are very healthy. Their business model is very robust. So I think that what you can see is that as a safety component of every portfolio, a large private sector bank would definitely have to be there. But is it going to be the growth component of that portfolio? I think the coming days will say that, depending on how the capex expansion cycle progresses. So that's in summary my view on the banking space. Like I said, it should still remain a core component of every investor's portfolio.
Okay, so stick with banks, don't get scared. That's the word with Sunil. Sunil, hi, good to have you on the show. Let's talk about the other big theme, right? The markets now had its time to digest all what the IT companies have reported and what the managements are saying. And there was some excitement because at least it wasn't as bad as what we had feared. But I think there's still a debate on whether this is the bottom or not. And, how do you see it? And, in your funds, when you talk to your fund managers, what is the call that the house is taking on IT?
I think our call is that the bottom has not fully been seen. I think there is scope for correction in the coming days because of the fact that I don't think that the growth valuations which they got in a post-COVID space, right? From a pre-COVID, when they were a decent growth, but a safety component of every portfolio pre-COVID, to suddenly becoming the super growth because of all this COVID-related changes and everything. That story, that hype took IT valuations very strongly up. Post which there has been air letting off, there has been a correction, but I would say that in our view, it's not completely done from a resettling those portfolios. That's number one. Number two is the fact that, but these are solid companies, so it's not like they are cyclical, and hence they will go through a very bad downturn. So they should remain the safety component. Third aspect is, now the news around the world of a 3-year rate cut, slowdown, all of that means that if the world is in a slowdown, IT companies aren't really going to be hitting it out of the park. But so to that extent, right, until the world clearly comes on a growth path, I don't see IT demand shooting through the roof. Then what will you see? What you will see is one company fighting with the other to grab market share. Some sacrifice of margins, but big deals being swung. So it's a very stock-specific, company-specific matter that you go and deal with it. The fourth aspect here, I would say, is that given the fact that the rupee, right, if you see RBI governor is saying, I'm not going to do rate cuts. Now, if Fed cuts the rate, right, and if 4 goes down, and RBI doesn't do a rate cut, it means there is a potential for depreciation of the rupee, right? Now, RBI governor is saying this today, maybe 6 months later, he may change his mind. But if you hold that view, then there is a slight depreciation possible in the rupee if the RBI doesn't do rate cuts while the Fed does it, which would be slightly beneficial to the IT pack. The fourth factor, I'm giving you a lot of factors out here, so I'm sorry for that. The fourth factor is that when I see FIS flows, after this, the profit booking phase which you're going through, I see till the elections them coming back fairly strong, and I see a big component of doing ETF flows. So to the extent that IT is a part of the benchmark, you will continue to get buying support from FIIs on it, right? Hence, our view as a fund is stick around the benchmark allocations that IT already has in various benchmarks. Stick around that, don't take variation and hang in there.
Okay, all right, Sunil, we've unfortunately run out of time, but thank you very much for your views on those two important sectors, banks as well as IT. We need to take a very quick break. We will get you more on the markets in just a bit, including some views and voices from a veteran. Hear what Vijay Kedia's view is on the current market setup.